Hi guys, it's Stock Curry, and earnings season is in full swing, which means it's time for me to give you my stock market predictions for 2023, as well as my predictions on how companies are going to report earnings this week. So let's get into it! Let's start with my stock market prediction for 2023, then we'll get into the earnings that are coming up this week. And let's go over some of the most recent economic news and data to give you a little bit of a background on why I am making the predictions that I am making. On Friday, the retail sales report showed that Americans pulled back on big ticket purchases as interest rates rose. Over the past 9 months, 6 of those months have showed a decline in spending, with only 3 of the months showing an increase in spending. And this is good. This is what the Federal Reserve wants. They want consumers to slow down the amount of spending that they do in order to get inflation down. The theory behind this is that if consumers spend less, that lowers demand. And as demand goes down, that causes prices to go down, or at the very least, to stop rising. And that will help slow down and end the high inflation that we currently have. At least that's the theory. Economists, on the other hand, have turned pessimistic on inflation, and they think inflation is going to stay and possibly even go back up. Economists expect inflation, as measured by the annual increase in the Consumer Price Index, or CPI, to end this year at 3.53%, which is significantly higher than the 3.1% prediction in January. And higher inflation also means the Federal Reserve will have to keep interest rates higher for longer. The midpoint of the Federal Reserve's current target range for the Fed funds rate now stands at 4.9%, but most economists see that midpoint rising to 5.125% by the end of June, meaning one more rate hike in May or June. And all of that makes sense, but here's where there's a major disconnect. Markets expect the Fed to then cut rates by the year ends, with 3 to 4 rate cuts by the end of the year. However, only 39% of economists think that the Fed is going to cut rates by the end of the year. Most economists don't see any rate cuts until next year. And this is really important to understand when it comes to trying to make a prediction for where the stock market is going to go for the rest of 2023. And that's because if you're in the belief that the Fed is going to keep rates elevated, they're not going to cut this year, then the market has to drop in order to price that in. Because if the market's currently pricing in 3 or 4 rate cuts and the Fed does none, the market has to drop in order to reprice no rate cuts. On the other hand, if you're in the belief that the Fed is going to cut rates before the end of the year, that means you are expecting a major recession, because the Fed will not cut rates unless we get a major recession. And if we do get a major recession, then the stock market is expected to absolutely crash. Typically, the stock market does not bottom out until 6 months after the Fed cuts rates if we enter a recession, if the reason for the rate cut was a recession, and usually it is. I mean, 12 out of the past 12 times, the Fed cut rates because we entered a recession. So if you are in the belief the Fed is going to keep rates elevated, you should expect the stock market to go down. And if you're in the belief that the Fed is going to cut rates before the end of the year, you should expect the stock market to go down a lot. And when it comes to the possibility of an upcoming recession, nobody is really questioning whether or not we're going to get a recession. The question now becomes, when will the recession start? An economist surveyed put the probability for a recession at some point in the next 12 months at 61%, the same amount that they did in January. However, they do expect the recession to be relatively shallow and short-lived, which is in line with other recent surveys. And the average economist sees the recession or contraction starting as early as the third quarter of this year. You should also keep in mind that both the International Monetary Fund and the Federal Reserve are both expecting a recession this year as well. So a lot of consensus there for a recession starting by the end of this year. So then the question comes, how bad will the recession be? Is it going to be mild? And is the government going to be able to say we're not in a recession, even though we are, once again, like they did last year? Or is the recession going to be very hard, where we see massive unemployment, we see a ton of problems in the economy, we see a lot of foreclosures in both commercial and residential real estate, we see banks collapsing? Just how bad is the recession actually going to be? And that's where there's still a lot of uncertainty. Surprise production cuts by some of the OPEC leading members, including Saudi Arabia, have sent crude oil prices sharply higher over the past month, and it could cause inflation to go back up, just as inflation looked like it was starting to come down. At the exact same time inflation is starting to go back up, economists expect stagnant growth this year, forecasting inflation-adjusted gross domestic product to rise just 0.5% in Q4 of 2023. And growth in 2024 isn't expected to fare much better at 1.6%. And with economists expecting a stagnating economy by the end of the year, at the same time inflation runs high, when you combine those two words together, stagnant and inflation, you get the word stagflation. And this is exactly what we had during the 1970s. During the 1970s, the US economy was in a stagflation economy for nearly 10 years. During that time, life was extremely difficult for most Americans. A lot of people were laid off. It was very difficult to find jobs. Those who had jobs did anything they could to keep them. A lot of people got foreclosed on because they could no longer make their mortgage payments. Inflation was sky high as people could not afford food or gas. There were gas shortages across the country. Everything about the 1970s stagflation environment was just absolutely horrible for Americans. And unfortunately, economists are expecting the economy to enter stagflation once again by the end of this year. Now, the question then becomes, how long will we remain in stagflation? What the Federal Reserve does not want to do is repeat the mistakes from the 1970s, where they were very, very slow in raising interest rates, and it allowed stagflation to last for over 10 years and resulted in 3 recessions. It took 11 years for the stock market to get back up to all-time highs. It was an absolutely terrible time. And we didn't get out of it until the Federal Reserve went full Paul Volcker, raised interest rates to 18%. And that's finally what got us out of stagflation. It killed inflation once and for all. And the question is, will the Federal Reserve do that once again? They don't want to make the same mistake as the 1970s and lower interest rates too soon. So more than likely, the Federal Reserve, at least they're saying that they want to do Paul Volcker. They want to keep interest rates higher for longer in order to knock out inflation, even if it means putting us into a deep recession. Of course, the federal government is going to do everything they can to not call it a recession, even though it is. And we have a new term now. The economy is likely to enter a slow session. That's right. Rather than the term recession, which everybody hates, and rather than the term stagflation, which everybody hates, we're now going to use the term slow session. Just a bunch of political hoopla. We all know what it means. Disaster for the U.S. economy. And of course, with inflation on the verge of going up, Fed officials back higher interest rates as banking stresses fade. Fed Governor Christopher Waller said he was prepared to approve another interest rate increase because recent bank system stresses have not produced a significant pullback in lending, while high inflation remains supported by strong growth. Meanwhile, Janet Yellen says U.S. banks may tighten lending and negate the need for more Fed rate hikes. But as Christopher Waller pointed out, banks have not tightened lending standards and financial conditions remain extremely loose. Unfortunately, despite all of the Fed's efforts to tighten lending standards, it just has not happened. In fact, lending standards are looser now than they were before the Fed first started raising interest rates. And it's also important to understand that a Fed pause would not necessarily refresh the stock market and cause it to go higher. A lot of people think that when the Federal Reserve does actually pause and stop raising interest rates, the stock market's going to rally. And they might be right for a short period of time. But people also think that when the Fed starts cutting rates, the stock market's going to rally. And history just does not back that up. Stocks have historically rallied after the Federal Reserve has finished raising interest rates. But markets might not get that same boost this time around, as some investors and analysts warn. Goldman Sachs looked back, and going back to 1982, the S&P 500 returned an average of 19% in the 12 months after the federal funds rate peaked. And that is absolutely true. But only for the data going back to 1982. So what is so special about that year, 1982? Well, 1982 is right after the Federal Reserve went Paul Volcker, raised interest rates to insane levels, and knocked out inflation. Since 1982, we have had very low inflation in the United States, or at least normal inflation. And during the period of normal inflation, when the Federal Reserve stops raising interest rates, the stock market rallies. Absolutely true. But what about when we don't have normal inflation? What about when we have high inflation like we have right now? What about when we had high inflation during the late 70s and early 80s? What about that period prior to 1982? Well, the stock market didn't rally for very long because every single time the Fed paused and lowered rates, inflation came back and the stock market sold off again. And that's why it took 11 years for the stock market to hit new highs. And that's why Goldman is skeptical that markets will in fact rally once again when the Fed is done with its current set of interest rate hikes. In addition to inflation remaining high, which is going to cause the Federal Reserve to keep interest rates high, which is going to cause any future recession to be much harder than expected, on top of all of that, earnings growth has faltered. S&P 500 companies are expected to report profits declining at the start of the year by the biggest amount since the second quarter of 2020 during the height of the pandemic. As company earnings decline, this should send stock prices down because it causes valuations to go up. And currently, stocks look expensive relative to history. The S&P 500 trades at about 18 times its next 12 months of expected earnings. That ranks it in the 81st percentile for valuations going back the past 40 years. That means going back the past 40 years, only 8 years saw multiples as high as they are now. 32 of those years saw multiples lower than where they are right now. So with inflation expected to go back up with increased oil prices and the Federal Reserve expected to keep interest rates higher for longer than the market's currently pricing in, and earnings expectations are expected to go down as companies report lower and lower profits, just like we saw with Delta last week, and multiples being extremely high, with the stock market currently at one of the highest valuations based upon historical standards, and the recession that is expected to start by the end of this year. All of that would point to the stock market going down. So why does the stock market continue to go up? Well, one of the things that's propelling the market higher is the strength of the economic data that we've seen in the first quarter, including inflation going down, the labor market remaining strong, and retail spending remaining strong. But importantly, a lot of that data is lagging. it does not tell us where we're going to be in the next 3 to 6 months. So the fear here is that as a lot of this lagging data starts to come in over the next 3 to 6 months, and it does in fact show that the economy is slowing down, that might cause the stock market to go down. But it's also important to understand market psychology. And right now, market psychology remains extremely bullish. 4 of the last 4 weeks have been green, with the market rising. The fear and greed index is at greed, and most of the technicals are pointing to a bullish trend that's going to continue. So right now, everything looks like the stock market's going to continue to go up when we look at market psychology and we look at the technicals. The question is, when are the fundamentals showing the stock market should crash and the technicals and psychology showing the stock market should go up? When are those going to come in line? And unfortunately, I just don't think it's going to happen this quarter. One of the problems that we saw last quarter is that earnings were horrible. Earnings were dismal. There was an earnings decline. Apple reported their worst quarter in years, and yet Apple stock rose. In fact, it skyrocketed. A lot of the companies that reported horrible earnings, their stock prices went up. So I don't really have a lot of hope for the stock market going down as we enter earnings season. Yes, I do think earnings are going to be bad. I do think companies are going to continue to report bad earnings, but I'm not convinced that stock prices are going to fall like they should. I think that for the next couple of weeks, stocks continue to rise. Now, where we might get a reckoning behind all of this is the old saying, sell in May and go away, meaning we might peak out here in April before finally seeing a sell-off in May. After that, though, it's just really hard to tell when the stock market is going to fall in line with the reality of the fundamentals. When is the stock market going to give up all of this hype and hope for this perfect scenario where inflation goes away within the next month or two and no recession ever occurs? This Goldilocks scenario, as it's now being called, which nobody believes is reality, and yet the market's pricing in. It's really hard to say when the market's going to wake up to reality. So the only prediction I can really give is that my guess is that for the next couple of weeks, we continue to go up. In May, we might finally go down. And then at some point this summer, the stock market peaks out and we actually have that sell-off in the third and fourth quarters of 2023. So that's my stock market prediction, just based upon all of the current fundamental, economic, technical, market psychology data that we currently have. Now let's get into the earnings this week and talk about some of my predictions for earnings that are coming up. Monday, as well as Tuesday before the open, banks remain in focus. Now, last week we saw JP Morgan report their most profitable quarter ever, with a huge amount of profits due to rising interest rates. And I do expect a lot of the major banks like Charles Schwab, Bank of America, Goldman Sachs, I do expect them to continue to show an increase in profits as well. The question really becomes, how are the regional banks going to fare? And that is where I just have absolutely no clue. Nobody does, because we have been completely in the dark ever since the banking crisis last month. And we're not really going to have any clue what's going on with these regional banks until they report on Monday and Tuesday. So extremely difficult to tell what's going to go on. If I had any guess in the world, it is literally just a guess, it would be that they would go up because people would realize that their financials are stronger than feared. They've already been extremely beat down last month, and I think we just get a little bit of rebound in the banks. But that's just a guess. Now, Tuesday after the close, we have Netflix and United. Netflix, their stock has been rising as money gets dumped into mega cap stocks, but their subscriber base has been slowing down and even turned negative one time. So I would think that Netflix might miss earnings. Their stock might go down. That would be my guess on that one. As far as United, I think they're pretty much going to come in line with Delta, where they see a decline in earnings due to higher fuel prices, and they just weren't able to raise ticket prices fast enough. So I think United will probably go down as well. On Wednesday before the open, we get a few banks as well as some healthcare stocks. I'm really not familiar enough with healthcare stocks to comment on those. So let's take a look at what's happening Wednesday after the close. And I think the big one here is Tesla. Now, Tesla, that's a tough one to predict. The thing about Tesla is they already reported record deliveries. And the stock rallied in expectation of that, but then the stock sold off massively as people realized, wait a second, all of these deliveries might not actually translate to profits because Tesla had to significantly lower the price of their vehicles in order to get those deliveries. And with much lower prices, that means much lower profits. So Tesla is really a toss-up. It already rose because of high deliveries, which means it already rose in expectations of record revenue. And I do expect Tesla to report record revenue, but Tesla also sold off in expectation of their earnings growth going down. And I also expect their earnings growth to go down. So the question then becomes, how do traders respond? Are they going to buy the stock because Tesla had record revenues and they're growing? Or are they going to sell the stock because their profit growth is going down, which in turn is going to lower their forward PE ratio? And I just don't know. Tesla is a really big fanboy stock. So trying to predict how it reacts to earnings is nearly impossible. My only prediction can be earnings themselves, in which I predict record revenue, but a decline in the rate of earnings growth. All right, Thursday before the open, we got Taiwan Semiconductor. This one, they were doing pretty good, but I'm really not sure on that one. Kind of a tough one there. American Express, they kind of follow the banking sector. I think they're going to go up. People have been spending a ton of money on credit cards. I think that stock is more likely to rise after earnings. I think they're going to beat earnings pretty strongly. Let's see. After the close, Procter & Gamble, Seagate, CSX. Not familiar enough with any of those to really give any ideas. So that's what I got for you guys as far as what I can tell. We do have a lot of pharmaceutical companies this week, but I'm just not familiar enough with them in order to give you guys any sort of prediction. So hopefully this video helped you get prepared for the week. If you want the rest of the information that you need to know before the market opens on Monday, including all of the Fed speakers this week, what economic data is coming out, my technical analysis, and everything else that you need to get prepared for the week ahead, I recommend you sign up for my free newsletter that goes out every Monday morning. In that free newsletter, I'll break down the technicals, I'll break down the upcoming earnings, I'll break down the market sentiment, including the fear and greed index, as well as the VIX. We also talk about a lot of other data that doesn't make it into the videos due to a lack of time. So make sure you guys sign up for that free newsletter so you can know everything that you need to know before the market opens on Monday. You can sign up for that free newsletter at stockcurry.vip/newsletter. That's stockcurry.vip/newsletter. If you got a lot out of this video, then be a good friend and share this video on your social media pages so that others can get prepared for the week ahead and can have a good idea on what to expect for earnings as well. And don't forget to hit the like button and subscribe. And if you missed the last video that I uploaded, make sure you watch the last video I uploaded here.